Good day! Thank you for sharing your time here at Zenshin Steps. Today, we're diving into index funds and why they don't all grow the same. Even if they sound similar, their results can vary a lot depending on the market. Our aim is to be of service to you by sharing ideas that can help you experience the joy and the magic of growth toward financial well-being. We're cheering you on as you keep moving forward along your journey. And it would really be a big help if you could like and subscribe to our channel. So let's start with what got me interested in index fund investing. I learned about this idea from the book Unshakable by Tony Robbins, and it completely shifted how I thought about long-term growth. It made me realize there are paths to grow my money and investments. This was later on validated after a number of years persisting in this journey by experiencing growth for my very own investments. It was also a blessing that this type of investment met my needs at that time, with its benefits of, number one, reduced risk through diversification, as I was very wary of risk from my failed investments previously. Second, resilient markets showing long-term growth performance as compared to the lower returns from my savings accounts. And third, the need for only passive management, given I was very busy at my corporate job at that time. To be transparent, these kinds of results don't happen overnight. The returns I saw took more than 8 years, but through patience, consistency, and staying the course, even across market shocks like COVID and other events, index funds became a solid foundation for my investing approach. So what exactly are index funds? They're simply investment funds that track a market index like the S&P 500. When you buy an index fund, you're not investing in just one company. You're investing in the whole basket of companies inside that index. That means when you invest in an S&P 500 index fund, you're essentially investing in all 500 companies in that index. It's a way to get broad market exposure without the need for actively managing your investment. This simplicity is one of its greatest strengths. In the course of my investing journey, I made a pretty big mistake early on. I assumed all index funds were basically the same. Market indices, same growth, right? Nope, not at all. And I learned that the hard way, through painful financial losses. Would really like to share these learnings with you so you won't commit the same mistakes as I did and safely avoid these index fund investment pitfalls for your journey. Here's what I learned. Let's compare two markets, the US and the Philippines. Both have index funds, but their performance over time is radically different. Look at how the US market, through the S&P 500 index, bounced back strongly after the market drop during the COVID pandemic. The US stock market, as seen through the S&P 500, has shown a pattern of recovery and resilience. Even as it was affected by market downturns like the COVID pandemic, it found its way back to growth after and even increased beyond its previous highs. Meanwhile, in comparison, the Philippine stock market did not bounce back in the same way after the COVID pandemic. It's still struggling to recover even up to this date. What's worse is that its value is even lower than the period before the COVID pandemic. This really showed me how important choosing markets that show better resilience over time is to enabling growth for the longer term. So here's my personal bittersweet experience. I made investments that tracked both the US S&P 500 Market Index and the Philippine Stock Exchange Index. And the difference, truly eye-opening. My investment tracking the US S&P 500 index grew over the longer term. On the other hand, my investment tracking the Philippine Stock Market Index, well, it didn't. And worse, it dealt me a painful financial blow. To illustrate this more clearly, let's say someone invested $100 in early 2018. If this $100 was invested in an index fund that tracks the US S&P 500 Market Index, that money by mid-2025 would have grown significantly to over $200. In contrast, if that same $100 was invested in a fund that tracks the Philippine Stock Market Index, it would have gone down to even less than the original $100 amount. Same concept, index funds, but very different results. From this valuable experience, I learned the hard way that index funds reflect the market they follow. Some markets are more resilient, and investing in index funds that track the indices of these more resilient markets offered superior long-term growth for my investments. This is something you also need to factor in when deciding your own approach. Though painful, to avoid further losses, I chose to pull out from my investments that tracked the Philippine Stock Market Index, even if they meant that I would lose money. Then, I reinvested these amounts to my investments that tracked the US S&P 500 Market Index instead. Looking back, it was a great decision, as this has led to longer-term growth in my investment portfolio. To keep this lesson always visible to me, I decided to keep a very small amount in my investment that tracked the Philippine Market Index as an enduring reminder to never repeat this painful mistake in the future. To wrap up our video, sharing these learnings. Not all index funds are the same. Index funds from stronger, more resilient markets tend to perform better in the long run. So choosing the right market is important in index fund investing. As we close, we just wanted to thank you again for listening and generously sharing your time. We hope we were able to serve you today in seeing that investing isn't just about picking any index fund, it's also about choosing wisely. As always, we're cheering you on along your journey to experience the magic and the joy of growth.